Okay, so the great thing is after you get through chapter 3 and 4, it kind of starts to get a little lighter and not as stressful. Chapter 4 is really just a lot of new concepts. Um, and so is chapter 3. So now we've got something a little more fun. It's intercompany profit transactions. So a lot of times, and we've talked a little bit, I think I mentioned the idea of the joint checking account. Uh, we have profits between companies, and they can't be used to inflate each other's balance sheets. So if it's within a parent subsidiary relationship, we just wash that off. So that's what we're going to be doing a little bit in this chapter 5, is eliminating these intercompany profits and showing them in our journal entries and balance sheets. Okay, so our goals for this are to understand the impact of intercompany inventory profit on consolidation work papers. We're going to start learning the concept of upstream and downstream inventory transfers. We're going to deal with, up and downstream is going to basically be the relationship between parent and subsidiary. We're going to defer unrealized inventory profits remaining in ending inventory. We're going to, and that'll make a little more sense once we get in there. We're going to recognize realized and previously deferred inventory profits in the beginning inventory, and then we're going to adjust the non-controlling interest amounts. So remember that it's not necessarily 100% ownership, so we have to adjust off the part that isn't owned by the parent. Okay, so the FASB has some guidance on this, and that basically is real simple. Intercompany balances and transactions shall be eliminated. That's basically it. Income showing and financial information should show as if there were no transactions taking place. In other words, it's a joint checking account. Okay, so the inventory situation is a little different. And if you think about inventory, think about a company, a large company and a subsidiary company working together, selling different goods or selling goods alongside, goods that help each other out. For example, let's say you have someone who makes desks and someone makes computers, and then the two kind of pair up and sell inventory between each other, for different things. So you can recognize the profit on this if it can be recognized if the goods have been resold to outsiders. So let's say you pair up together to do something, and then you sell it outside of the company, both companies. It can also be deferred if the goods are still being held in inventory. And then this is where you just have to stretch your brain out a little bit. Previous deferred profits in inventory, beginning inventory, are recognized in the period where the goods are sold, assuming first in, first out FIFO. Okay, beginning inventories are sold, and ending inventories are from current purchases. So that's a little bit using the FIFO. So we're not going to use any other method, first in, first out. Okay, so let's do an example of this. Ray sold goods costing $1,000 to its subsidiary, and Sky had a gross profit of 30%. Sky had none of the inventory on hand at the end of 2016. So here's the worksheet entry. All right. So the first thing you have to do for the intercompany sales is you've got to figure out you've got to divide it by 1 minus 30% to get the amount of sales, the actual selling price. So because the information you're given is the goods are cost $1,000 and the gross profit is 30%. So to eliminate it, you're basically going to take off the gross profit, all right, and divide it by the 1 minus 30% or 70%. So that's our worksheet entry. And basically what we're doing is we're shearing off the gross profit. Okay, and there's some keywords here. All intercompany sales of inventories have been resold to outside parties. So you'll remove the full sales price from both sales and cost of sales. So both sections are Ray's sales are reduced, and then Sky's cost of sales are reduced by the 1429, and it's the same entry if they sell it backwards between the two of them. Okay, so during 2017, Kai sold an additional goods of 900 to Taj at a gross profit of 40%. Taj had 200 of these on hand at the end of the year. So we're going to have to do some calculations, right? Okay, so let's go ahead and look at the journal entry for this. So the first thing we have to do is eliminate the intercompany sale between the two of them. So it's going to be a debit to cost of sales, a debit to sales and a credit to cost of sales for 1,500, which is the 900 divided by 1 minus 40% or 0.6. All right, and then the next thing is the deferring of the ending inventory. So you're going to defer the profit from that by multiplying that times 40%, which gives us the 80. And then you're going to credit out the inventory. So you're basically just kind of shearing off this intercompany sales and shoring up and shortening the ending inventory since it's an intercompany ending inventory. So last year, Max sold goods costing 300 to its sub Leo at a markup of 25%. Leo had 120 of this inventory on hand at the end of 2016. During 2017, Max sold additional goods costing 500 to Leo at a 30% markup. Leo had 260 of these goods on hand at the end of the year. Alrighty, let's go take a look at what we're working on. So the first thing we're going to do is worksheet entries for 2017, and I pulled in the problem from previous page so we could just have it here. So the first thing, we're going to eliminate the intercompany sales. All right, so we had additional goods of 500 plus, so we're going to take off, I noticed they did it 30% of 500 to get the sales and cost of sales. You know, you could also just come in and do 500 or 500 times the 1.3, and that'll give you the same thing. Let me just show you what I'm trying to say on the calculator. There's 500 times 1.3. I did the little multiplication sign. There you go. Equals 650. A little shorter cut than having to add back 30%. Just a little tidbit. And then our cost of sales for this next part, we're going to multiply the part that's on hand at the end of the year. Right here, this 260 of goods on hand. We're going to multiply this right here times 30% divided by 130%. Okay, and that will give us our, that's where we're getting our 60. So we're basically taking our markup right here and dividing it by 130%. It's just kind of hard to explain the math here. But the idea is 30% of the 650, basically, because 650 is I don't even really know how to say this correctly in math terms, but that's how we do it. Just divide by 130, which is what we did here to 130%. All right, and then for the investment, we're going to realize the deferred profit. So same situation. We come in here, they had 120 of this inventory on hand. All right, we'll multiply it times the 25% markup. And this is the stuff from 2016 right here. All right, so there's a deferred profit from the beginning inventory. So we have to come in, do a second step to adjust that deferred profit. So we're going to do a little discussion of upstream and downstream sales. Okay, so we're going to go ahead and start working on the concept of upstream and downstream sales just to try to understand. Um, so let's pretend like we have a parent subsidiary. They have several subsidiaries, all right? So here's the thing. Think of a staircase. Think of uh, seniority. Downstream means when the parent, think of the parent as always being at the top. Downstream means when the parent sells something to a subsidiary. Upstream sales means that the subsidiary is selling something to the parent. So make sure you have the concept of downstream, parent to sub, upstream, sub to parent. So basically, these are our journal entries for eliminating intercompany profits. And this is just the best way is to take this sheet, screenshot it, and then load up your journal entries exactly like this sheet for an intercompany inventory sale. And these are the journal entries, and then depending on the amounts and the proportions from the examples that we just used. So for upstream, the only thing here, the upstream, if you do an upstream, difference between, because these are all for downstream example, okay, right here, downstream example. For an upstream, the last thing you do is a debit to non-controlling interest. Shared the realized profit between the controlling, or basically you're sharing the realized profit between the controlling and non-controlling interests. So that's the last little bit. Everything else is the same for upstream except for that last little information. Okay, so let's go ahead and take a look at this example that we're getting ready to go through. And this is basically what we have. Subsidiary income, 5,200, dividends, 3,000. Current amortization acquisition price is 450. Intercompany sales during 2016 were 650. Intercompany profit and ending inventory was 60. And intercompany profit beginning inventory was 24. Okay, so let's take a look at how this shakes up. And I also put this over here on the corner because I find it's hard when you go to the next slide, you tend to forget things. So here's our shakedown. And at this point, I hope you're really good at peeling off that income between the subsidiary and the non-controlling interest. So the first thing I'll look at here, sub-income, 5,200 right here. Here's our calc, right? Current amortizations, we had that right here, 450 from the problem. Again, subtracting off. I'm just gonna, so I don't make this too slow, I'm gonna come over here. Okay, and then here's the deferred profits from ending inventory. Remember with the downstream sale, going to defer it right over here. Note here too, before I go in here, we've got to break out our 80% share. I started to do this and I kind of, I forgot to break this out. Let's stop really quick and break out our, before I get too deep in this, let's break out our parent and sub of the adjusting income. Hopefully you all are amazing at this right now, right? Parent, and then let's go ahead and do the sub. Right here. There's that. See, same thing as last chapter, right? So now we've got our adjusted income broken out. Okay, so on the profits here, new stuff, that's coming out of the parent. Oh, that color's too dark. Hang on. Let's do a lighter one. Light blue. Did I already do that one? Try to see if I find that. That's a little brag. Yeah. Sorry, being picky. Okay, we'll just leave it blank then. I'll just circle it. So right here, our deferred profit right here. My mouse here. coming right off here in the parents share. All right. And then we have to recognize the profits from beginning inventory. So let's do that next. Again, this is downstream. We're thinking parent and sub, right? Right here. And this is our income from our sub right here. Now, all we have to do from here is break out the dividends. And this is old hat to us because we've already done this in previous chapters. So it should feel very safe and secure for you to break these dividends out really quick. Dividends between parent and sub. Subs dividends. Okay, so that's basically it. It's just a few extra steps from what we did. The only items is the deferred profits, and then the recognized profits, and then just breaking out the amortizations between the parent subsidiary. It looks complicated, but it's really not. I think you guys can do this. So just little tidbits of information. It's not as bad as last chapter, I think. Okay, so let's go ahead and take a look at the upstream sale. And hopefully it won't feel as hopefully it'll feel just like old hat. So first thing we're going to do is let's go ahead and match up the incomes like we did on the last one. All right, from the example, take the sub income, 5,200 right here. Oops, did not mean to. I'm getting really good with drawing with my finger. Alrighty, so here again, I mean, amazing. It's amazing what being forced to make this online class online has done for my ability to make a slideshow. It's awesome. Okay. All right, and then here we have our current amortizations. So these are just the first things that we pop right off. We know a lot about amortization, right? Those are super easy. There you go, right here. All right, and then we have our adjusted income, which we're going to break out between controlling interest share here, right here, and non-controlling interest share right here, broken out completely. Okay, we're going to defer our profits in ending inventory. Again, little different because it's upstream sales, so we have to do a little breakout. So there's a lot of arrows going on here in this example. So what I'm going to do is I'm going to take dark blue and try to point you in the direction right here. So here's our deferred profits, 80% right here. And then 20% right here. I was trying to line it up with the actual arrow, but okay. You see where I'm going? Don't let all that extra arrow confuse you. It's the same stuff we've been doing. We're going to recognize profits in beginning inventory, 24, right here, and right here. I actually think downstream sales is easier than upstream. That's just my opinion. Maybe I'm just a glutton for punishment. And then our sub dividends, breaking them out between the two right here. And we have broken out. You guys are so good at this by now. Probably don't even need me to be drawing the arrows. But I'll just draw them anyway, just to get the practice. Okay, a little extra, trying to line that. Okay, pretty easy compared to what we just went through. I think you all are going to be amazing at this. Okay, so we're going to move on to unrealized profits and ending inventory. So if we have ending inventory, we talked about beginning inventory. Now we're going to talk about ending inventory on hand. We're going to eliminate that at the year end, and here's your journal entry. It's just simply shortening up the inventory with a debit to cost of sales. Okay, so let's look at the parent accounting. So there's two separate types. So in this particular situation, Pam owns 90% of Sun at book value, no amortizations. During the current year, Sun reported $10,000 income. Pam sold goods to Sun during the year for $15,000, including a profit of $6,250. Sun still holds 40% of these goods at the end of the year. So here it is. Figure this part out. This is what the unrealized profit right here, 40% of the $6,250. Right? Okay. Still owns 40% right here. So the income from Sun is 90% of the income right here, minus 2,500 unrealized profits, which we just figured right here. And this is our income. And our non-controlling interest share, go ahead and get that figured out simple. 1,000. Okay, so I realized whenever I do these things, I don't put any jokes or lightning moments when we're doing our lectures online. So I'm going to try and work on that. But anyway, I just came to that realization. I thought every single time I do a slideshow for you, I have to go in and move everything around so I can put my little video over here in the bottom right hand corner. And I was like, I wonder if they know when they're making these slides, don't they know that we have to move everything around? And on top of that, try to squeeze the previous information on there. So if they look a little hodgepodgey, that's what I'm trying to do, so you can have as much information as possible. Anyway, you know, struggle is real. Okay, so let's go ahead and do the journal entry to record income net of unrealized profit. So here, this is what we just figured, the 6,500. So now we're just doing a quick journal entry here, right from here to here. And our journal entry is basically bringing the income in and increasing our investment, or the value of our investment. The worksheet entries to eliminate intercompany sale and unrealized profit. Again, because I'm squishing, this is 15,000, by the way. So our worksheet is our profit from that beginning of the year time, right up here, right? We kind of talked about this on the previous page, but didn't do much with it. That's our profit right here. And we also want to take care of that ending inventory right here. And that's where that comes from. And again, if you take that sheet where I gave you the list of journal entries and just plug and chug, that's what I would suggest you do. Okay, so here's the worksheet for the income statement. Again, Pam's sales, very interesting. Nothing we're doing there with it. We're mostly concerned with how we are consolidating Pam and Sun sales. Now remember in chapter 3, we just kind of added everything together. Now we're having to kind of peel off that intercompany sales amount. So right here is where we would do our cost of goods. Right here. This is our cost of goods from up here, 15,000. I'm sorry, our sold goods. Bite my tongue. Okay, and then we're going to debit it to reduce our sales to get our consolidation. The income from Sun. All right, we had that figured up in this part right here from earlier calcs. And now we're going to go ahead and take it, but then we're going to eliminate it. So at the end of the season, at the end of the statement, it's a zero balance. Our cost of sales, all right, we have this cost of sales is for them, because this is and Sun. What we're taking out of our cost of sales is this little 2,500 right here. It's a little too dark. Oopsie. Can't see it. Let's go with this light color here. I think it's one of these green ones here. Right here. And then we're crediting back this right here, these sales right here, we're going to credit back. So these will now wash When we did the debit, we show it in the sales, but now it's going to wash out in our cost of sales. This is the wash right here. And that just basically eliminates all the stuff in between them. Here's our wash. Okay, our expenses, 15,000 expenses for Pam. All right, and that's right here for the expenses. Actually, can I bite my tongue? That is not cost of sales. I don't know where I was going with that. My apologies. And then our expenses. These are just from the worksheet and they're added together. Sorry, bite my tongue. I didn't mean not to go down that road. I almost went down that road. I caught myself. The cost of sales right here. I'm sorry, the non-controlling interest share is taken out. We figured it right here. We take it out right here. And now we have a rundown of our controlling interest on the consolidated income statement. Okay, so the next thing we're going to look at is recognizing profits from beginning inventories. So what you have to realize with this is that if you have unrealized profits in ending inventory, and I know I sound like a broken record here because I'm sure I've said this a few times, ending inventory becomes profits to be recognized in the beginning inventory next year. So if you have something in ending inventory 1 year, it becomes next year's beginning inventory. So let's look at the impact on non-controlling interest. Okay, so the impact of unrealized profits in ending inventory and realizing profits in beginning inventory depends on the direction of intercompany sales. So if it's a downstream sales, then you have a full impact on the parent. If you have an upstream sales, then you share the impact. You share it between the parent and the NCI, the non-controlling interest. So anything downstream, everything go to the parent. Upstream, still to the parent, but only the part that they own. Okay, so here are the calculations to calculate the income and the non-controlling interest. So in this case, remember downstream parent to sub. All right, here's your formula to get the income from the subsidiary and break out the non-controlling interest share. And then in upstream, again, here's the formula. So the best thing for you to do is just to screenshot this sheet and kind of keep it handy and use it for your calculations. Okay, so we're going to do an upstream example, which means we're going to go from sub to parent. All right, so Phoebe acquired 70% of Shay on 1/1/16 for $420 when Shay's equity consisted of 200 capital stock and 200 retained. Shay's inventory was understated with the building, was understated, and the building with a 20-year life was also understated. Any excess is goodwill. Okay, so I hope at this point you all know how to set this up on the sheet from previous chapters, just kind of, do the additions and subtractions. Separating out the income, this is new for 2016. These are the breakdowns between Phoebe and Shay. Now, in order to fully comprehend the upcoming sheets, really consider making a screenshot of this, putting it in the corner as I'm walking through this explanation. More information. In 2016, Shay sold goods to Phoebe at a 20% markup. 240 of these goods were in Phoebe's ending inventory. Okay, so Shay sold to Phoebe. Phoebe has some ending inventory of that hasn't been used. In 2017, Shay sold to Phoebe again at a 25% markup, and there's still some inventory on hand. It's a great example how we feather all this out. Okay, so we got a lot going on here, so let's get a schedule going. First off, let's look at the amortization. Okay, so we have a few things. We have inventory which was understated by 50. So that's our first area of working. And trying to get it all on one page. Hopefully you can see from page 1 This is our inventory right here, understated by 50. So we'll take care of it right here in the amortization. Remember that this is from 2016 regarding the inventory, so we don't have anything to worry about there. Same thing with the building. The building was understated by 100. Did it tell? And it has a 20-year life, so we're going to divide that 100 by 20, right? To get the $5 or 5 amortization. All right, so this gives us an unamortized balance. It's a 20-year life, so it'll come off again in 2017. Okay. The goodwill comes through and just sits here. It's not amortized. Right, so here's our schedule. Our cost, let's come back up here. I'm going to go a little backwards here. Our cost was 70% of Shea from right here. I like to go backwards. I think I'm a backwards thinker sometimes. 70% of Shea for 420 right here. So we do our implied value right here. 600. The book value, capital stock of 200 and 200 of retained earnings right here. And now we have the excess figured. Hopefully this is feeling like old hat. You guys are good at this by now. Okay, so let's look at the upstream income sharing. I just want to point out this is super small, so you might want to come back and take a look at that slide. So we're looking at Shea's net income here, which is the 705. Barely see it here. Go back and double check your slide. I was trying to fit everything in. All right. And then the current amortization, 55, which we figured on the previous slide, right, gives you the adjusted income of 650. Now we're going to break out the two shares. These arrows are much better than the last set, by the way. Right here to the NCI share. Oops. Right here. Break out the two shares. Okay, let's look at the deferred profits. All right, the deferred profits. This is from our ending inventory, okay? So our ending inventory becomes the following month's beginning inventory. And those will be broken out between controlling and again, non-controlling here. And then that is our income recognized. And then of course, you all already know how to do dividends. I don't even need to show you, right? Sub-dividends broken out between the two. Okay. Last but not least, we do our journal entries based on our entry schedule, and we'll go ahead and make our equity entries for the acquisition, for the cash and the dividends, and the investment and income will basically be washed out here. Adjustment for errors and omissions. We're going to take out the intercompany sales and the cost of sales right here from the inventory. And then we're going to adjust the income and the investment. This investment based on the eliminating the subsidiary income and dividends. And then of course, I know you can't see this in the bottom. You'll have to go back and look at your sheet. And you'll go ahead and eliminate all the reciprocal balances as we have done in the past. And also the amortization. All right, so I hope you find upstream and downstream sales a little easier to manage. It's a great chapter. Make sure you know the difference between the two. And I encourage you to keep these working papers as you go out into your practice, because believe it or not, these things come up. Companies merge. You may be considering a merger yourself and looking for the right ways to do the journal entries, particularly if you're a smaller or mid-sized firm concern. So definitely keep these informations. You never know when 10 years from now you'll be looking for a way to book this. All right, have a great week. And chapter 5, this concludes chapter 5. Chapter 6 coming out shortly.